Did we just see the first real risk-off pulse of the cycle? In the last 12 hours, roughly $100 billion came off the total crypto market cap, all while gold ripped to fresh record highs. This pairing of events is worth noting because it is not random volatility. This is capital making a decision about where it wants to hide when the world starts feeling unstable. Here is the question that defines how you treat the next 2 weeks. Is this tariff-driven move simply a leverage flush that fades once forced selling clears? Or is this the start of a broader risk-off escalation, where every bounce gets sold and every headline carries weight? Because the setup here is unusually specific. Trump just outlined an additional 10% import tariff starting February 1st, targeting goods tied to 8 European countries, with language pointing toward a potential step up to 25% by June 1st, framed around Greenland. So this is a negotiation tactic. And Europe is already discussing retaliation of roughly 93 billion euro, while signaling it could deploy larger tools designed for economic coercion scenarios. That is the point where a one-day flush can turn into a multi-week mood. So stay with me. In a few minutes, I'll connect this to the October 2025 tariff shock. I'll show you what rhymes here. I'll show you what genuinely feels different. And then we're gonna layer in the Tuesday catalyst happening this Tuesday that can swing the entire tape with a single push notification. So let's begin. Let's start with the clean reality. This did not begin on a Bitcoin chart. It began in geopolitics, and markets heard it as an escalation risk. Tariffs are never just numbers on a spreadsheet. Tariffs are a message. They signal that trade is becoming leverage, and leverage makes capital nervous. And nervous capital behaves predictably. It stops reaching for upside and it starts reaching for shelter, for security. And that is why gold surged while crypto bled. Crypto is where risk gets repriced the fastest. What made this feel heavier than a single headline is how Europe reacted to. This was not brushed off as political theater. European officials openly discussed retaliation and referenced the anti-coercion instrument, a framework reserved for moments when economic pressure becomes a weapon. When that language appears, timelines stretch. Hours become days and days become weeks. And this shock landed in a fragile environment for many reasons. Liquidity was thin, positioning was crowded, and the first wave of price discovery ran straight through the most reflexive part of the system, the places where leverage lives. Stops cluster and liquidity vanishes exactly when everyone wants out. That's why crypto looked like a crash site, even though crypto was not in the headline. Now, if you've been in the market for some time, you would know that crypto is the fastest fear gauge on the board, so to speak. It does not wait for debate or confirmation. It reprices emotion immediately. When a macro shock hits, the first response usually runs through derivatives. Perpetual futures act as a 24/7 pressure valve, letting traders take sides with leverage. And on calm days, leverage looks like jet fuel. It can really instigate things fast. However, on shock days, it becomes a trapdoor. And here's a choreography in plain terms and how it plays out. A headline hits, price moves quickly. Traders position the wrong way, get pushed towards liquidation thresholds. Exchanges auto-close positions, and that forced selling pushes price lower. And lower prices trigger more liquidations, and more liquidations create more forced selling. So what looks like panic is often just mechanics. This is exactly why the flush versus escalation question matters. A flush is violent and fast, and then it quiets down. The fuel burns off, the tape stabilizes, and real demand gets a chance to show itself. Escalation stays loud. It manufactures fresh fuel through new headlines, and the market never fully relaxes. So, how do you tell which world you're in? You watch three things that do not care about narratives. You watch whether safe havens stay bid. You watch whether Bitcoin can reclaim its ceiling. And you watch whether leverage immediately tries to rebuild after being punished. To understand how this typically resolves, we need to look at the rhythm. We have seen this movie before. On October 10th of last year, 2025, Trump announced a plan to raise tariffs on Chinese imports to 100%. Risk assets sold off sharply. Crypto followed. The unwind turned historic, with roughly $19 billion in liquidation as leverage completely wiped out. And here's why we use this comparison. The mechanics rhyme. A surprise policy shock, then liquidity. Futures lead the move. Stops cascade. Leverage resets. Then, once forced selling clears, the market begins searching for real demand again. We just watched the same opening act. A shock headline, thin conditions, rapid repricing, leverage taking the first hit. Crypto absorbs the damage because it is the fastest place to de-risk. So remember that and keep it in mind if you're going to be investing in crypto and if you're new. That said, what is different this time? Well, Europe is not a peripheral counterparty. It is a deeply integrated ally block tied into US trade, services, and capital markets. And Europe is signaling it's willing to respond with more than one lever. That raises the odds of tit-for-tat dynamics. And tit-for-tat is what makes markets feel heavy because every rally starts needing permission from the next headline. That brings us to where we are now. This move can still resolve as a clean flush, but the backdrop can also evolve into a longer risk-off regime. And Tuesday sits right in the middle. Tomorrow, Tuesday, January 20th, is a Supreme Court opinion day, and a major tariff legality case remains pending. The legal details matter less than the structure. Decisions can land without advance notice. Markets know this, and markets are already braced. This is a push notification environment. You can go to sleep in one regime and wake up in another. So here are the two paths. If the court limits tariff authority, markets typically read that as a ceiling on escalation risk. You often see relief across risk assets, safe havens cool, and crypto finally gets breathing room as the fear premium leaks out. Confirmation is not the first green candle. It is follow through. In that scenario, the level to watch is the mid-90s. Call it $95,000. Bitcoin reclaiming and holding above that zone through real liquidity hours is the market telling you buyers are back in control. Though, if you are a long-term investor, this matters less for you because you're going to hold no matter what, because Bitcoin goes up to $1 million. So all of this risk volatility really doesn't matter so much for you. However, for those of you who do trade from time to time, though I don't personally encourage it because I'm not a trader, I'm nevertheless sharing this in case you are watching short time frames and want to understand what's going on. So, if the court validates the tariff path, markets tend to read that as permission for escalation to remain live into the next step-up window. Safe havens stay bid. Risk assets feel heavy. Crypto bounces struggle to stick. Altcoins feel it first. The confirmation is equally clear. Bitcoin rallies into that same $95,000 ceiling and repeatedly stalls, while gold continues making noise. So here is the simplest takeaway of this entire episode. When Bitcoin holds above $95,000 and gold stops making new highs, the odds favor flush and rebound. When Bitcoin keeps falling near $95,000 and gold stays on a tear, the odds favor escalation and chop. That is your compass. So here are the 10-second rules. Rule 1, loud tape means you can wait. When headlines swing, liquidity thins, and a binary catalyst sits on the calendar, forcing trades is how people donate money to the market. Rule 2, a flush ends when liquidity stops rushing back in. A real reset feels quiet. Funding stabilizes. Open interest stops ballooning. Bot demand becomes the leader again. You do not need perfection. You just need the market to stop acting fragile. Rule 3, gold is the narrator. Gold making new highs, while crypto bleeds, is capital paying up for certainty. When the narrator quiets down, risk gets oxygen again. When it stays loud, risk punishes impatience. Now we close the loop. A flush has a distinct feel: violent, fast, and then calm. Liquidation's clear, panic fades, price starts moving with intention again. Escalation, on the other hand, feels different. It's heavy, interrupted, rallies stall early. The market never fully relaxes because the next headline always feels close. Right now, we have elements of both. Flush mechanics are present, but the geopolitical backdrop raises the odds of extension. That means the smartest posture or position this week is not maximum aggression, it's maximum clarity. Just being steady-handed. Your job is to watch the tells. Your job is to avoid overtrading noise. Your job is to stay patient enough to act when odds actually improve. Institutions do not move on vibes. They move when regimes shift, when legal clarity improves and cross-asset signals stop screaming danger. That patience is your edge. So as we close out today, here is the map. A tariff headline hit a thin market and triggered a rapid leverage unwind. Crypto took the first punch because crypto is the fastest risk gauge we have in the market. Gold ripping to record highs at the same time tells you capital is nervous. The October 2025 rhyme reminds us how brutal these flushes can be and how quickly they can resolve once leverage clears. What's different now is Europe's posture and a Supreme Court opinion tomorrow that can flip the mood instantly. So respect the tape, respect the calendar, respect the cross-asset signals. And remember this line: it will save you this week. Loud tape or loud news in the media means you can wait. Stay sharp. Keep stacking sats, and I'll see you in the next video tomorrow. Take care.